Study objective 2 is about depreciation. So remember now, we have this matching principle in accounting, and that basically says we record expenses in the year that they relate to producing revenue. So when we buy assets that last for a lot of years, how do we expense those purchases? And the answer is the matching principle makes us expense the purchase over time, and that is called depreciation. Depreciation in an accounting sense is not the value of the asset. It's nothing to do with like a blue book value, anything like that. It is just simply the process of allocating the cost or the expense of an asset over its useful life. So if a truck lasts 6 years and it costs $6,000, we're just going to expense $1,000 a year because that's the period of time that the truck helped us make money. Okay, so that's called straight line depreciation, and I don't want to make it more complicated than it is. That is what you do. It's just allocating the expense to the period that you use the asset. So we have to see how to do this then. How do you compute depreciation? The factors that go into that: cost, what's the truck cost you, what's its life, and then is it going to be worth anything at the end of its life that you expect to get back? Is there a salvage value? Do you expect to get $1,000 back because it's scrap metal? I don't know. So you don't want to depreciate that part. You don't want to expense that part of the truck's cost. You want to subtract all the rest of the cost. So let's look at a calculation then. Study objective 3 gets into the methods. Straight line is the one we're going to use in this class. There are two other methods of calculating depreciation that are of lesser significance to us. So under the straight line method, we have an example here of a truck that costs $13,000. The expected salvage value is $1,000, so that's the amount we think we're going to get back at the end of its life, which is 5 years. Okay, so all you do is you take this cost, you subtract the salvage value, and this is the $12,000 that we want to depreciate over the life of the truck. Divide the 12 by the 5-year life, and you get $2,400 a year as depreciation expense. This table kind of shows you how the depreciation expense would be recorded every year. 1/5 is 20%, so 20% of the cost. There's your $2,400 every year. At the end of the year, then, you'd have this other account called accumulated depreciation. This is an accumulated total of what's been depreciated so far or expensed so far. And then the difference between the cost and that accumulated depreciation is known as the book value. That's the amount of the cost of the truck that hasn't been depreciated yet. It's not the value of the truck. It's not the value of the truck. All right, it's just the amount of the cost that hasn't been depreciated yet. And that's what we're going to report on the balance sheet in the asset section. Much the same as we have the cash realizable value for AR, we're going to have the net book value of equipment, buildings, things like that. Declining balance method and the units of activity method, you can read through those. There's a comparison of methods that will produce different expense amounts per year. So you should look kind of through those. Look at depreciation and income taxes. Different methods are used for tax purposes usually. There's a note in the financial statements regarding depreciation. I'll talk about study objective 4 on the next video.